Silver just lost its biggest customer. The solar industry, which at its peak consumed 200 million ounces of silver every single year, is actively replacing silver with copper. Chinese manufacturers are building panels that contain zero silver. JP Morgan published a report in February 2026 calling silver, and I'm quoting here, an existential threat to the solar industry. At $120 per ounce, silver went from 1.5% of panel costs to over 30%. Industrial demand is now falling to a 4-year low, and every analyst on financial television is telling you this is bearish for silver. That's exactly backwards, because there's a mechanism hiding inside this market that turns demand destruction into a buying signal. Every ounce the solar industry saves gets swallowed by investors who see scarcity and buy more. The silver market is heading for its 6th consecutive year of supply deficit. And when you understand why demand destruction makes this metal more valuable, not less, you'll see why this is the most misunderstood story in precious metals right now. My name is Alex, and I've spent the last decade tracking commodity cycles, central bank policy, and precious metals data so you don't have to. I read the Silver Institute annual reports, the JP Morgan research notes, and the metals-focused datasets cover to cover because the headlines almost never tell you the real story. If you want to actually understand what's happening in these markets, instead of just reacting to them, make sure to hit that subscribe button and give this video a thumbs up if it helps you see this differently. Before we dive in, I want to know, what's your silver price prediction by the end of 2026? Drop it in the comments. I read every single one, and I'm genuinely curious where this audience thinks we're headed. Because here's the thesis of this video, and it's going to sound counterintuitive at first. The worse silver's industrial demand gets, the stronger the investment case becomes. Silver has a dual identity that makes it behave like nothing else in the commodity world, and that dual identity is about to create one of the most asymmetric setups I've ever seen in precious metals. But to see it, you need to understand 3 things that almost nobody is connecting right now. Let me paint you a picture of what's actually happening in the solar industry, because the scale of this shift is staggering. Back in 2016, solar panels consumed roughly 80 million ounces of silver per year. It was a growing market, but manageable. Then the global push for renewable energy kicked into overdrive. Solar installations exploded. Silver consumption from photovoltaics climbed and climbed until it peaked near 200 million ounces. That's a 150% increase in less than a decade. Silver became the solar industry's most important raw material after silicon. But here's the thing. That relationship was built on silver being cheap. When silver was trading at $15 or $20 an ounce, it represented about 1.5% of total panel manufacturing costs. A rounding error, nobody cared. Then 2025 happened. Silver rose 147% in a single year, the strongest annual performance since 1979. It hit $121 per ounce on January 29, 2026. And suddenly, that rounding error became 30% of panel costs. Imagine you're running a solar manufacturing company in China. Your margins are already razor thin because of overcapacity. Chinese producers have been flooding the market with cheap panels. And then your silver bill triples. Then it quintuples. You're not going to sit there and absorb that cost. You're going to find a way to use less silver or no silver at all, and that's exactly what they did. The Silver Institute released their annual outlook on February 10, 2026, and the numbers tell the story clearly. Industrial fabrication is forecast to decline 2% in 2026, falling to 650 million ounces, a 4-year low. The primary driver is photovoltaic sector thrifting and substitution. In 2025, solar silver demand declined for the first time ever, down 5% to roughly 85 million ounces. And it's falling further in 2026 despite record global solar installations. Let that settle in your mind for a moment. The world is installing more solar panels than ever before, and silver demand from solar is going down. Manufacturers are achieving 15 to 20% silver reduction per panel in a single year. A French research group called CEA achieved below 14 milligrams per watt, which is a 44% reduction from the industry average of 25 milligrams per watt. Copper cord silver paste is cutting silver content by 30 to 50% per panel, with less than 1% reduction in conversion efficiency. And then there's the nuclear option. Cadmium telluride thin film technology uses zero silver. JP Morgan's analysts wrote, and I quote, "The largest risk we see for silver comes from more widespread adoption of silver-free technology." A company called JXTC has been developing copper plating technology for a decade, and it's now reaching commercial scale. The timeline for industry-wide adoption is 2027 to 2030. So here's the obvious conclusion, right? Silver is losing its biggest industrial customer. Demand is cratering. Prices should fall. That logic falls apart when you look closer. And what I'm about to show you next is the thing that separates silver from every other industrial commodity on the planet. Pay attention, because this is where the real story begins. Let me walk you through 3 dynamics that turn this bearish narrative completely on its head. The first one I call the investment feedback loop, and it's something that exists in silver and almost nowhere else. When industries optimize away from a commodity, what normally happens? Demand drops, prices fall, and the commodity gets cheaper until a new equilibrium is reached. That's what happened with lithium. When lithium demand softened, prices simply collapsed. No floor, no catch, straight down. But silver isn't lithium. Silver has a dual identity. It's both an industrial metal and a monetary metal. It sits in the same category as gold in the minds of hundreds of millions of investors worldwide. So when the solar industry announces it's using less silver, something bizarre happens. Investors don't see reduced demand. They see confirmed scarcity. They think, if even the solar industry can't afford this metal, it must be incredibly valuable, and they buy more. The Silver Institute's data confirms this. Bar and coin demand is forecast to surge 20% in 2026 to 227 million ounces, a 3-year high. Western physical investment is recovering after 3 consecutive years of decline. Chinese gold ETFs saw record inflows of 44 billion renminbi, roughly $6.2 billion and 38 tons, in January alone. Global exchange-traded product holdings sit at 1.31 billion ounces. That's the feedback loop. Solar thrifting saves maybe 45 to 55 million ounces. Investors absorb that slack instantly and then some. Every ounce saved through optimization becomes available for investment hoarding rather than price relief. The industrial customer walks away. The monetary buyer steps in, and the deficit continues. If you've made it this far, you're already ahead of 90% of the people talking about silver right now. But don't stop, because the second dynamic is even more important, and it's the part most people never hear about. The second dynamic is what I call the inelastic floor. Not all industrial silver demand is created equal. Solar might be learning to live without silver, but there's an entire category of demand that physically cannot substitute. Medical applications. Silver wound dressings in hospitals. Aerospace components that are certified specifically for silver and cannot legally switch to alternatives without years of recertification. Mission-critical computing connectors in data centers. These applications will pay any price. If silver goes to $200 an ounce, hospitals still need silver wound dressings. If it goes to $500, aerospace companies still need silver-certified components. You can't tell a surgeon to use copper bandages because silver got expensive. You can't tell Boeing to swap out a silver connector because the quarterly budget looks tight. This represents over 200 million ounces of demand that is completely price insensitive. It doesn't care what silver costs. It's buying regardless. So when you hear that industrial demand is falling to a 4-year low, understand what's actually happening. The price-sensitive demand is leaving. The price-insensitive demand is staying. That changes the entire character of the remaining demand base. It becomes stickier, more resilient, and less responsive to downward price pressure. Now here's where it gets even more interesting, and this is the third dynamic that almost nobody is talking about. While solar is walking away from silver, a brand new industrial consumer is walking in. Artificial intelligence data centers. The expansion of data centers and AI-related technologies is emerging as a major silver consumer. Circuit boards, connectors, thermal management systems, all of it requires silver. The Silver Institute's own report notes that expansion of data centers, AI-related technologies, and the automotive sector are expected to support silver consumption. Electric vehicles are adding silver demand through electrical contacts, battery components, and charging infrastructure. So the narrative that silver's industrial future is collapsing because of solar thrifting misses the fact that new demand sources are partially backfilling the gap. Solar leaves. Data centers arrive. The net effect is much smaller than the headlines suggest. I know what you're thinking. Okay, Alex, the demand picture is more nuanced than I thought. But what about supply? If supply is growing, doesn't that fix the deficit? Here's a hard truth. It doesn't. And the math is brutal. Total silver supply in 2026 is forecast at 1.05 billion ounces. That's up 1.5%, and it's a decade high. Mine production specifically is projected at 820 million ounces, up 1%. So supply is growing. That's true, but it's still not enough. The Silver Institute projects a 67 million ounce deficit for 2026. That's the sixth consecutive year of structural deficit. Let me put the cumulative number in perspective. Over the past 5 years, the silver market has run a combined deficit of over 800 million ounces. That's nearly an entire year of mine production that has been consumed and not replaced. And this is happening at decade-high supply levels. The mines are producing more silver than they have in 10 years, and it's still not enough to meet demand. Physical supply in London remains tight. COMEX registered inventory has been drawn down dramatically. Think of it like a bathtub. The faucet is running as hard as it can, decade-high flow. But the drain is open wider. Every year, more water leaves than enters. And after 5 years, the water level is visibly lower. You can see the porcelain. That's where we are in the silver market. The tub isn't empty yet, but you can see where this is going if nothing changes. And here's the uncomfortable question. What changes? Mine supply takes 7 to 10 years to develop from discovery to production. You can't flip a switch. New silver mines aren't appearing because silver was $20 5 years ago and nobody was funding exploration at those prices. The supply response to higher prices is measured in years, not months. Now let me tie all of this together, because when you see how these three dynamics interact, the full picture snaps into focus. We're in the home stretch, and I've saved the synthesis for the end because this is the piece that connects everything. The real magic here happens at the intersection of silver's two identities. On one side, you have the industrial identity. Solar is thrifting. Demand is falling. That's real. On the other side, you have the monetary identity. Investors see a metal with 5 consecutive years of supply deficits and a sixth one projected. They see tight physical supply. They see a gold-to-silver ratio that fell below 50 in January for the first time since 2012. And they see a metal that rose 147% in 2025. These two identities create a self-reinforcing cycle that doesn't exist in any other commodity. When industrial demand weakens, it should relieve pressure. But the investment side interprets that weakness as a signal, not a solution. Scarcity is confirmed. Hoarding intensifies. The deficit persists. Most commodities have a straightforward price discovery mechanism. Demand drops, prices fall, equilibrium is restored. Silver's dual identity prevents clean price discovery. The industrial exit becomes the investment entrance. The bearish signal becomes the bullish catalyst. And the deficit, which should be closing, stays wide open. This is exactly what happened with the price action. Silver rose 11% in 2026 as of February 9, even as the Silver Institute announced falling industrial demand. The market isn't confused. The market understands that the scarcity is structural and that losing a price-sensitive customer while gaining price-insensitive investors makes the supply picture worse, not better. Remember that bathtub I mentioned earlier? Here's the update. The solar industry just turned the faucet down slightly by using less silver, but the investors just opened the drain wider. The water level is dropping faster, not slower. That's the paradox. That's the mechanism. And that's what makes silver the most misunderstood asset in the precious metals space right now. The analysts who are calling solar thrifting bearish for silver are applying single identity commodity logic to a dual identity monetary metal. They're treating silver like lithium, like copper, like any other industrial input. But silver isn't any other industrial input. It's been money for 5,000 years. And when you have a metal that's simultaneously an industrial commodity and a monetary store of value, demand destruction in one identity feeds demand creation in the other. The bearish case and the bullish case are the same case. They're just seen from different angles. Your future self, the one looking at silver prices 2 or 3 years from now, is going to remember this moment. Not because I gave you a price target or told you what to buy, but because I showed you the mechanism that everyone else is misreading. The solar industry fired silver. And silver got more valuable because of it. That shouldn't make sense in a normal commodity. But silver has never been a normal commodity. What's the next topic you want me to dig into? Silver mining supply chains, the gold to silver ratio, central bank gold buying, the data center metals demand boom? Drop it in the comments. I read every single one, and the best video ideas come directly from you. I'll see you in the next one.